What's up, guys? This is Terrence Lewis with LewisHelps, addressing the issue of whether to buy rentals by putting a down payment down or using the BRRRR method. Guys, I wanted to do a video for you guys and explain to you guys the difference between doing a BRRRR with building a rental portfolio, which stands for buy, rehab, refinance, and repeat, versus just building a rental portfolio by putting money down on a property and buying properties already ready to go. Which one should you do? Which one's right for you? Well, hopefully this video will help you guys understand whether BRRRR is right for you or whether the down payment program is right for you. I get this question a lot. People ask me, about the BRRRR method when it comes to buying properties and building a rental portfolio. Obviously, we understand that buying rental properties is the way to financial freedom. It is the way to build assets. It is multiple streams of income with rental properties. We can go through a few of those here today. Buying rental properties obviously helps you. There's what I like to identify as the big four for rental property income, right? And there's a few of them that you may not have understood. Obviously, we understand that rental properties, most likely when you buy a rental property, you're looking for the cash flow. So you're looking for that difference between what the mortgage is, the vacancy rates, the property management, always get property management, and the maintenance cost. And after all those expenses, what's left over is called your cash flow, and that is what you want to consistently build up. So that way, one day you can sit on the beach, relax in the Bahamas somewhere, and enjoy yourself while receiving income, letting those properties or that income or that money that you put into those properties work for you. So that's ultimately the goal. But there's several other incomes that come with building rental portfolios, right? Which is what makes real estate so great. Yes, you get the cash flow, but you also get what's called appreciation of the property. Typically, when you put a down payment down or you employ the BRRRR method, you're building in or you're putting down a down payment. And that margin of what the house is worth and what you owe on the property, that is called your equity. So if you are a person that has cash, a heavy cash flow, or you're the type of person that makes really good income and you're looking for a place to defer that or to avoid paying taxes on that income, putting your money into real estate is the best way to do it. Because you still get to keep the money instead of paying taxes on it. You keep the money. That money actually gets to make money for you because that property is actually going to appreciate over time, making that property more and more valuable. So while the renters are paying down the property loan, that whatever it is that you have on the property, in reality, the value is actually increasing over time. Okay. So you have the cash flow, you have the equity position. You also get the write-offs, so that down payment as well as any expenses that you incur on that property, the interest that you're paying on that property, you get to write that off against your actual income that you're making. So having that property gives you the cash flow, it gives you the equity position, it gives you the write-offs, but the government actually allows you to write off the fact that the property is depreciating. Anything that sits for long enough will return back to the dirt or will depreciate, right? It will deteriorate. So the government actually allows you to write that off as a depreciation value for that property. So you get the income for the property monthly, you get the value of the property that can actually increase, you get the property that you get to write off the money that you put into the property, and then you get to write off the fact that the property depreciates. Now, let's go back to figuring out which one of these are for you, right? So obviously we talked about the down payment method being somebody that doesn't really want to get involved in the fixed and rehab side of the real estate project itself. So if you're the type of person, again, that has a significant amount of income, you don't really have the time and you want to invest, there are people that invest with investors like myself that will come in and actually just want to invest their money and let that person flip their money or let that person help them build a rental portfolio. I actually do have a program like that, so definitely tap in. You can find me on IG if you're looking for services similar to that. Now, obviously, we have to have that equity position in that property. That equity position, which would be your down payment, or I'm going to explain in the BRRRR method, that would actually build in the equity. That's very important. It's important because we know, just like stocks, the value of houses go up and down over the years. So that margin of what you put down and that margin that you build into the property, that's going to help you from actually being in a position where if the market drops, you owe more than what the house is worth. Okay, so it's a bridge or it's a buffer of market protection, but at the same time, it's there to help increase your value, your net worth, right? So obviously buying houses that are already fixed up, that are already ready to go, is a great method if you have capital. But now what about those that don't have capital, right? In my programs that I have, my Partners in I Students program, we actually build in that equity, right? Most people that come into this business don't have a significant amount of savings that are set aside, or they don't, they don't have a retirement account that's set up where they just have a bunch of money sitting aside, or they don't even have equity in a home that they own that they can pull from. So what we do is what's called the BRRRR method, right? The BRRRR method allows you to take unsecured lines of credit like credit cards or personal loans or business lines of credit, right? And you can actually get this money and buy properties at a discounted price. Now you can buy those from wholesalers, you can buy them by just driving for dollars, putting out bandit signs. There's a lot of ways that you can attract people that are looking to sell their distressed home, right? So the way that you're actually going to go about this and the whole method behind it consists of two very important things. A, what the bank is willing to give you for that property is in the terms of a loan, right? And then B, the margins between what you buy it for and what the house will be worth when you're done repairing it, which is also called the ARV, the after repair value. So once you determine the after repair value of this house, in this scenario, let's say it's worth $100,000 when it's done being repaired, and the rehab on the house is $25,000, okay? So now you have $75,000, okay? Now, the goal for you is to actually buy the house and fix the property up of 75% of what the home will be worth, okay? So if you know the home will be worth $100,000 and you know the bank is going to give you $75,000 of that $100,000, that means you need to buy it, fix it, and refinance it all for under $75,000. So in this scenario where the house would be valued at $100,000 and it's $25,000 worth of repairs, that would mean you need to buy the house for $50,000. Okay, so if you bought the house for $50,000, you put $25,000 worth of repairs in it, you know that you have purchased it and have rehabbed it for less than 75% of what the ARV was worth, which was $100,000. So in that case, you were able to buy the property, fix the property up, and refinance it with a loan, thus giving you your money back and your rehab money back, giving you one consistent loan that the tenants will pay off, doing the same thing that the person that put the down payment down did. You now have a 25% equity position for market adjustments. That's your equity and your net worth. You also have a loan in place that allows you to get your money back. And so both ways are really good ways of building your rental portfolio. One allows you to consistently recycle the same dollar amounts to build up your portfolio. So you only have to, work your way up to getting that dollar amount. Now these, obviously in most rental markets, you're talking about prices under $200,000, right? My sweet spot is around $100,000. So I look for houses similar to the scenario I just painted for you. I buy them for $60,000 or $70,000, put 20, 30 into them. They're worth $120,000 to $130,000, right? So that's my bread and butter. So I just wanted to do a quick little breakdown, which one will be right for you, whether you should purchase properties with a down payment or whether you should go with the BRRRR method. I wanted to find out from you guys, what is your method? Which one do you think is right for you? If you're the type of person to build a rental portfolio, which one do you think you fall under? Do you fall under the buying a property and putting a down payment down on a perfectly good rental property already ready to go? Or do you think you're a BRRRR method type of a person? Either way, if you need more assistance, definitely don't forget to tap in. It's Terrence Lewis with LewisHelps. For more information, please jump over to the IG channel. Over there, we're actually giving out daily content and tips like this on a daily basis. So don't forget to leave your comments. Let me know what you think. Looking forward to speaking with you guys, and I do get back to you guys in the comments, so make sure you guys check that out. Don't forget to subscribe, hit that pound button, and share. It's Terrence Lewis with LewisHelps. Peace.